affluence.
Oh,
Oh, so
oh,
well,
now I
now
got to
we're
start.
recording it. Oh well. Anyway, we're welcoming American Riviera Bank, ARBV. Jeff, is Michelle going to be driving the
She
presentation?
is. We look like we're starting a little bit early.
Oh yeah,
So
a couple
I
minutes.
just want to make sure that I can get her on because she was going to drive the presentation. So let me go next door to the office and grab Michelle and have her get onto the Zoom. I'll be right back.
Okay, great. Terrific. There's been, we hope to ask them a few questions about some M&A activity in their marketplace and how that's going to impact California, I guess, is a question for everyone and whether there's opportunities there.
Can you hear me? Okay. Ian, I'm back. And Julian, I'm back. Thank you so much for allowing us to present at the virtual bank conference today. We really appreciate the opportunity. Michelle Martinich, our CFO, is on the Zoom. We may not have video from her, but she is going to drive the presentation. So Michelle, if you can share screen, we'd like to start with page 3 of the investor deck. I'm not sure how we're going to get the investor deck out of Michelle if we can't have a video out of her.
Well, we have it. We could run it for you.
Oh, you can. Could you run it from your side?
Julianne, do you want to? You're on mute.
Yes, sorry, I can run it. I've got it right here.
That would be great. Thank you, Julian.
Absolutely.
Jeff, as a brief introduction, you want to spend a couple minutes just talk about yourself and how you came into to the bank and how, just a brief history of your tenure there.
Yes. Okay. So I'm president and CEO of American Riviera Bank, and I have been in this seat since 2008. The bank started in 2006, and it's been a fantastic journey. And I'll go through it a little bit with some of the slides. We'll touch on this since I know that some of the folks on this call may or may not be familiar with American Riviera Bank. So starting with page 3, which is the overview of American Riviera Bancorp. Thank you. Looks like we're there. We're getting there. Okay, perfect. Scroll it just a little bit more.
Yeah, I'm sorry. I'm just trying to get this to take up the whole screen.
Okay.
Hold on one second.
Okay. Well, I'm going to give
There
you.
we go. Okay. All right. Now I've got it. I apologize. Which slide would you like to start on?
If you could start on slide 3, which is the overview.
I apologize. Okay.
Oh no, you're doing great. Oh, there it is. Okay.
Here we go. Okay.
So, American Riviera Bank is based on the central coast of California. So for those of you not completely familiar with where we're based in Santa Barbara, we're about an hour and a half north of Los Angeles and maybe about 4.5 hours south of San Francisco. So definitely closer to Los Angeles than San Francisco. But we consider ourselves, the central coast of California. We're not necessarily Northern California. We're not necessarily Southern California. And you can see that we have 6 branches spanning from down in south by Santa Barbara. We have a branch in Montecito, which is just south of us. We have a branch in Goleta, California, which is just above us. And then we have Santa Maria, San Luis Obispo, and Paso Robles. And so we're 2 counties, the Santa Barbara County and San Luis Obispo County. And one of the things that is distinct about the central coast of California, I would say for sure, a few things would be there's major universities. So in Santa Barbara, we have UC Santa Barbara. Up in San Luis Obispo, we have Cal Poly, San Luis Obispo as major universities, as well as great opportunities for companies spinning off, as well as new employees and new talent for the bank. We also are an area that gets a considerable amount of tourism. There are wine grapes grown here. There's a lot of opportunities for people to come here to enjoy the coast. and to enjoy some wine tasting. And so we find we get a fair amount of visitors that come into town from Los Angeles, take the train. The same is true of San Luis Obispo, where people come down from the Bay Area just to spend a long weekend and enjoy the Central Coast. And I wanted to point that out in particular because our economy still feels very vibrant. And I know that things are different across the country and pockets of the country. But here in Santa Barbara, we have found that our restaurants are still very full. Our hotels are experiencing great occupancy rates. Our small businesses seem very strong at the moment, and I can touch on this a little bit later on, but we're seeing very little C&I usage of lines of credit at the bank. And that has dwindled a considerable amount. I would say a couple of years ago, we were probably seeing about 15% of our loan outstandings were coming from C&I, and that's dwindled to about 7%. And so I think that that has a lot to do with a combination of stimulus and the strength of the local businesses. In this higher rate environment, they've chosen certainly not to borrow when they don't have to. And so as an overview of the bank, you can see this on page 3 in terms of our stats. We're about $1.3 billion approximately. And one of the areas that we focus on is, I like to say, small to medium-sized businesses and medium to high-end consumers. And we have a lot of professionals in the bank. We have a lot of CPAs, attorneys, as well as construction industry. So contractors and architects and engineers makes up a big part of our client base. So I think we can move on to the next slide. I wanted to spend a little bit of time there just giving you an overview of where we are. I will also move through this slide fairly quickly, but the history of the bank, there's been a couple transformational events in the history of the bank. And I would say the first was that back in 2016, we did a merger of equals before a lot of us were talking about MOE. We did a merger of equals with the Bank of Santa Barbara. So American Riviera came together with the Bank of Santa Barbara, and we were both close to 200 million in assets at the time. And so when we came together, we were 400 plus million, and we knew that we would be on a glide path to pass $500 million, with a goal of being $1 billion bank. And things actually moved quite quickly for us because after the merger, we made a decision to move into San Luis Obispo County, so our county to the north. And there was really an opportunity because we'd seen continued dislocation in our market, and there were no longer any community banks based in San Luis Obispo, California. And so we made a decision in 2017 to go up to Paso Robles, and we found a team to come work for us and started with an LPO and later converted to a branch. And then we did the same thing with San Luis Obispo. And we started with an LPO and moved into a branch. And what's really amazing about going up into Paso and San Luis Obispo is that in a very short amount of time, that team has really grown what might be a small bank in a lot of communities of the country. So between Paso and San Luis Obispo now, they have about $400 million of deposits. And they have a fairly considerable amount of loans as well that they've contributed to the overall bank. We did form a holding company in 2022 in order to take advantage of the window for subordinated debt. And we did actually issue 18 million of subordinated debt at very favorable terms at 3.75% back in March of 2022. And there was a stock dividend as well, which occurred in 2022, a 10% stock dividend. I know it was a question from Julian before. She was wondering if we're going to do another stock dividend this year. And we do not plan to do another stock dividend this year. But we might consider it next year, might consider it as a possible every other year strategy. At this point, that's still on the table. So we can go to the next slide. Lastly, we did open up Santa Maria as well, a new branch in the middle of our territory. This is just a quick slide for you at a glance to see the growth in our deposits and in our loans. And of course, like many banks, we've seen a decline in deposit balances from the latter part of 2022 into 2023. Our most recent quarterly results were released recently, and we had a very nice increase in deposits this quarter, with the vast majority of that coming from non-interest bearing checking. And so we felt very good about that, but you can see the growth there in loans and deposits. I would point out that it is probably unusual for us. It is unusual for us to have less than 10% loan growth. I mean, we've been a bank that year after year after year is generally running 12 to 18% loan growth. And that's been somewhat of a hallmark of American Riviera Bank. And of course, we're in a bit of a different environment right now. And so when we're offering rates at the coupons that we're offering them at now, which is about a minimum of about 7.75, and certainly there's a lot of rates that we're quoting in the 8s and in the 9s. It certainly has slowed down demand for loans. And as I mentioned earlier, we find with our C&I clients, they're doing just about everything not to borrow from the bank right now. And I think that that's positive from an economy standpoint. If we do go into a bit of a downturn at some point in 2024, I think the fact that a lot of C&I borrowers have been strong enough to not borrow from the bank or have injected personal funds into their companies in order to avoid borrowing from the bank, it's probably a nice sign that they will be able to weather the storm if there is a storm. We can go to the next slide. I do just briefly want to comment on the management team without going into any particular detail. The main thing I like to say about the management team is we made a decision back when we were about a $750 million in asset bank that we were going to go past the $1 billion mark, and we did need to be prepared ahead of time. And so we added 2 positions to our team back at that point, which was Laurel Sykes, our Chief Risk Officer, as well as Paul Abramson, our Chief Technology Officer, both of whom had worked for a $1 billion plus bank and knew what the expectations were from the regulators of being $1 billion plus. And they've been fantastic adds to our team. Our team is very young. I am the only gray hair on the team. And I think it's been another thing that people have noticed about American Riviera Bank is that we're young and we have a lot of energy. And we do enjoy what we're doing here on the Central Coast. So you can move to the next slide. Thank you, Julian. I wanted to point out a little bit about, what's the rationale? Why would you want to own American Riviera Bank stock? So the first thing is, it is important in this environment today, becoming even more important, that we have a very large percentage of our deposits are non-interest bearing checking. We're at 42% of our total deposits, and that percentage has actually hung in there over the course of the last year. And if you add what we used to have was a component of now accounts, which are now interest checking. If you add those, we have 54% of our deposits are in checking accounts or transactional accounts. And that is a hallmark of our relationship-based banking, that we're not just about doing transactions, we are about having relationships with our clients. And that has been very helpful in keeping our costs low. And we'll talk about that. Our loan to deposit ratio is 85%. And we typically are a bank that runs about 85 to 95% loan to deposit ratio on a regular basis. So this is an area that we're pretty comfortable with. This is coming back in line for us compared to where we were when all the stimulus was available and all the deposits increased. And we saw our loan deposit ratio decline pretty substantially back during the COVID days. We are a growing franchise on the Central Coast of California and with a stable deposit base. Credit quality is strong. I do want to point out that we are starting to see a difference maybe between certain communities across the country, maybe certain banks with their performance as it relates to credit. But right now our credit is very strong and we have a very small amount of non-accrual loans in relation to our total loans. Generally our stock, which is traded on the OTCQX, has been less volatile than some of our NASDAQ traded peers. And we have a slide for that later on in the deck, page 21, which goes over performance. But American Riviera Bank stock has actually performed rather well compared to the KBW Regional Bank Index over the course of the last year to date, even over a 5-year period. You can see some of the statistics here in terms of our trailing earnings per share and our annualized earnings per share this year of $1.93. We're trading at about 8 times earnings. And you can see where we're trading in relation to book. We do have an AOCI position on our bond portfolio. And so you can see that if you were to add that back, we're trading at about 78% of our tangible book value with the add back, and pretty close to book as if you were to continue to exclude the AOCI. So we can move on to the next slide. We'll go over our balance sheet mix and what we've noticed on our loan side. I would say in general, I'm going to point out that we have a fair amount of commercial real estate on our books. We are a very, we're a well-tuned commercial real estate lender. We have a lot of clients that are commercial real estate investors and have been investing in the Central Coast commercial real estate for a considerable amount of time. And we also have a book of residential loans because we actually have a residential lending department, which is a little bit unusual. Not every bank does that these days, but we offer mortgages on primary residences as well as investment properties. So I would characterize our loan book as being a little bit more fixed rate in that it generally, we would offer people 5, 7 to 10-year fixed rate loans. And you can see that our loan yield reflects that. We're at a 5.15 overall loan yield in the third quarter. That's up from right around 5% in the second quarter. But it is important to note that we have not seen as much of an uptick in our loan yield as you might see in certain banks that have a higher percentage of variable rate loans. On the flip side, we've benefited a considerable amount from our deposit base. And you can see that we had a 90 basis point cost of deposits in the third quarter. That was up modestly from 73 basis points in the second quarter. And, our overall cost of funds was just north of 1%. It's also very reasonable. So we benefited on the deposit side. And maybe we've lost a little bit of upside on the loan side just because of the components of our loans that are fixed for 5, 7, or 10. And we also believe that there's an advantage to some degree of having the clients that we have locked into the rates that they have. And I'll just point out that we believe we're a little less exposed to a downturn in the economy, because our clients are paying us on their commercial real estate loans generally between 4 and 5.5%. So they have very good rates that they've locked in, and they don't really face any repricings until 2026, 2027, 2028. And so I feel that there would really be a very limited reason for a client to struggle making payments with the coupons that they have on those commercial real estate loans. I think we can move on to the next slide. This is just another depiction of the balance sheet and the loans and deposits coming closer in sync now since the spike that we saw in deposits in the 2021-2022 timeframe. I think that's all I really needed to comment there. You can go to the next one. You can also see how our deposit mix breaks out. As I mentioned, you can see in the green area there on the left, you can see the large component of non-interest bearing checking accounts. And then in the lighter green, the now in interest bearing checking accounts, you can see that that's a pretty large component. We have very little CDs in the bank. This tends to be a little bit more of a money market in California than it is a CD market. So on the right, you can see where our cost of deposits is in relation to Fed funds. We can go to the next slide. Okay. Just wanted to point out that our deposit base is very diverse. For those of you that aren't familiar with American Riviera Bank, we are kind of a true community bank. So there really is no concentration that exists within our deposit book. No concentrations over 2% of our total deposits. We're not involved in doing anything unique or niche, like we're not involved in anything with cryptocurrency, not involved with cannabis, not involved with money service businesses, etc. So it's just a reflection of our community as a reflection of the deposit base. We can go to the next slide. Michelle, are you available to speak on this? If not, I will just address this right now. But we have considerable liquidity that is available to the bank.
I'm connected now.
Okay, great. You can talk. Perfect.
I can talk and I can be seen, sort of.
Okay.
There we go. Yeah, so like Jeff was saying, we have significant liquidity on balance sheet, and more importantly, off balance sheet. We do not rely on any brokered or wholesale funds. We are very focused on reducing even our FHLB borrowings. They're kind of normal course of business to use FHLB borrowings, but of course the FHLB is really smart and they're expensive. So the less of those we can have and the more we can have of deposits, that's really a win for us, and we're enjoying seeing that come down from a high in the second quarter. We cut that in half in the third quarter, and we continue to chip away at using less FHLB borrowings. But you can see we've got $230 million. Of course, we can always go to the Federal Reserve, and we've got lots of Fed fund lines. So we feel good about our available sources, and our focus just stays on gathering deposits, since that's where the real value is.
Perfect. And I just wanted, since we're at this point, and I took a pause there while Michelle was talking, I noticed that there's a few questions that have been put into the chat, and I thought I'd address a couple of them quickly, and then later on we'll address a couple related to commercial real estate with one of our latter slides. So the first thing is, somebody asked who did our stock and sub debt offerings, and our stock offering that we did back in 2018, I believe, at this point.
Correct.
Yeah, stock. Oh no, I'm sorry, 2019. 2019 was our stock offering. That was done by DA Davidson. And the sub debt was also, we were helped by DA Davidson on that particular sub debt offering. And there's some questions about commercial real estate. So I'm going to hold those. And let's go to the next slide in the deck. Michelle, would you like to briefly comment on the investment portfolio?
Sure, and it ties into the question that's there in the chat too. So we have a lot of mortgage-backed securities. So when we look at expected cash flows, it's different than what the call report will show with scheduled maturities. So although the cash flow off of the security portfolio has been low this year, we do think it's going to be more between $25 and $30 million over the next couple of years. So we look forward to that starting to reduce and allow us to redeploy that cash in other ways, especially in a higher rate environment. So the interesting part about our interest rate risk profile is that we are almost as neutral can get, and we've been that way for a couple of quarters now. So in an up and down rate environment, we are just slightly sensitive, but to the point where it's very flat. The curves are very flat. So that is nice that we've managed that risk, and now we just need to think about any action we can take to, in a safe and sound way, of course, take a look at that NIM and redeploy some of these low-yielding assets into higher-yielding assets. That is an ongoing effort.
That's a good transition, because I did see that question in the chat as well about our lower-yielding asset. I think the question said basically, compared to peer, you have a low yield on earning assets of 4.48 last quarter. How do you plan on increasing that? And it's coming from a combination of things. So as we mentioned, we have benefited from our low deposit cost. And so what we've seen is because our loans and our securities have a high component of fixed rate or hybrid fixed rate, we have an opportunity to reprice those as they come up to a repricing date or a maturity. And we're continuing to get cash flow, of course. And the offering rates on the new loans that we're putting on the books, of course, are at a much higher rate. But what I would characterize a little bit is we're a little bit lower on the yielding asset side, but we're also lower on the deposit cost side, which has probably put our NIM right around median or kind of just above median for peer group. And so I think we've benefited, of course, from the depository side. We continue to see cash flows, as Michelle outlined, on the investment portfolio here, as well as on the loan book. And so that will continue. And we saw, as you saw, a pickup there in loan yields from about a 501 to a 515 in just one quarter. And we see that continuing to happen. I feel like, and I know Jillian wanted to ask this question. She said, well, when are you going to bottom out on NIM? And I think that that's a really difficult question to answer because nobody's really sure exactly what's going to happen with deposits and rates. But I do feel like we've seen some stabilization the last couple of quarters in NIM. And it was my feeling that we would probably bottom out on NIM somewhere around the second quarter of this year or third quarter of this year. We'll have to see if that holds true, but it does feel like it's very close to the bottom. So let's go on to the next slide. Credit quality has been strong and continues to be strong. The bank has had, 3 years of 0 or negative charge-offs. We've had net recoveries in a variety of quarters. Our loans right now, we have a very small component of non-performing assets. You can see that it's 2.7 million out of about a $950 million loan book. And of that 2.7 million, 2.1 million is a single loan where the client is actually paying principal and interest. And we have it on non-accrual, and it's at about a 30% loan to deposit ratio. So we're not really concerned about that loan at all. And we continue to see strengthening credit trends at the bank, not weakening, but strengthening as we continue to see any sort of credits rated substandard, special mention, and watch. That pool of loans has continued to decline over the last year as opposed to increase. Next is the commercial real estate slide, which I think there may be some questions here, and so I wanted to make sure that we address it. Although we're a strong commercial real estate lender, and it's a big part of our loan portfolio, our actual loan portfolio is quite diverse in terms of the types of commercial real estate that we do. And so you can see by looking at this chart, the different components and the percentage of the commercial real estate portfolio, as well as the percentage of capital. There is no one particular category that exceeds 100% of capital at this point. You can see that hospitality is the top there at 96% of our capital. You can see that we slice and dice this twice a year with credit, with stress testing our commercial real estate book. And we take updated financial information from our clients with rent rolls and operating statements compared to the most recent appraisal that we have. And we take a look at our weighted average loan to value. We take a look at our weighted debt coverage ratio. And as you can see here, the regulators have been very happy with the way that we've managed the process of commercial real estate. And when they look at our book of business and they see what our average loan to values are and our average debt coverage ratios, they felt very good about the overall commercial real estate book. Somebody asked a question in the chat about vacancies. And my general comment would be, and there's a couple comments I have about commercial real estate. First of all, it really does depend where you are. And, American Riviera Bank has very much stayed in its lane in terms of lending on commercial real estate on the central coast of California. We don't have loans in Los Angeles, in San Francisco, in Chicago or New York. We are not lending on office towers. We are lending on local real estate, and we're lending to people that have generally owned their commercial real estate for a considerable amount of time. Commercial real estate investors that have multiple properties and have been doing this for decades. It's kind of reflective in the loan to values that we have on our books, that a lot of these people came to us for refinances and did not come to us for purchases. And so the question about vacancies, yes, we are seeing some vacancies, but at the same time too, it's not as widespread here as it may be reported in the large metro areas. We do not have, we don't have as many companies deciding that they're going to be completely remote and giving up their space. It certainly is a factor. But if you've lent on a property at a 40 to 55% loan to value, and it has some level of vacancy, and you took a personal guarantee from the owners of the commercial real estate, you're not likely to see that property come back, even though it has vacancies or even though the debt coverage ratio may take a ding. So we haven't seen any delinquency whatsoever in our commercial real estate book, even though some of our borrowers, of course, have had to deal with vacancy or turnover in their tenant base. I think we can move on to the next slide. And I just wanted to point out that all of the capital ratios of the bank have been increasing nicely over the course of the last year. We kind of knew this was going to happen, that growth was going to flatten out in a higher rate environment. You were going to see some deposits leave the bank. You were also going to see some reduced loan demand. It's kind of played out the way that we thought. And we've seen sequentially over the course of the last 4 quarters, all of the regulatory capital ratios have been increasing. And in addition, the TCE ratio, which a lot of people were concerned about and talking about in relation to banks that had some level of bond portfolio and AOCI, our TCE has come up quite nicely over the course of the last 4 to 5 quarters. And we're right about a 7% level now on TCE. And that was down in the 5s back at the moment when the bonds first started to have some struggles with AOCI. You can go to the next slide. Profitability trends. You can see what those look like right now. I want to comment on this briefly, and Michelle can give a little bit of color on this. If you're looking at our ROA right now and you're saying, why is the bank's ROA going down? If you look back at the 3rd quarter of last year or the 4th quarter of last year, compared to now, what is going on with American Riviera Bank? So first of all, in the 3rd and 4th quarters of last year, we were really in some pretty amazing operating conditions, I would say at that point, because we still had a considerable amount of excess deposits that were sitting at the bank. So as rates came up, we had an opportunity to invest those funds overnight and to get a much higher yield on it. And there was a considerable amount of interest income that was coming into the bank in the 3rd and 4th quarter of last year because of that excess depository position. And so that was a little bit of a heyday there for us in the 3rd and 4th quarter, which makes it a little difficult when we do quarterly comparisons to the 3rd and 4th quarter. But as we entered into 2023, and as most banks experienced in 2023, a significant amount of deposit runoff, especially with what was going on in March, we saw our deposits come down. And of course, we went from a position where we had excess deposits to a position where we actually went into FHLBs and we're funding some of our balance sheet with FHLB advances. We were actually carrying $70 million worth of FHLB advances at the end of the 1st quarter and at the end of the 2nd quarter. We're happy to report that our reliance on FHLBs declined pretty substantially in the 3rd quarter because of the deposits that came in. And so we were at 35 million in FHLBs at the end of the 3rd quarter. But as it relates to ROA, there's also an expense aspect to this. And it's something that's very deliberate and was planned. In 2023, we had to absorb some expenses related to 2 non-recurring events. One was that we consolidated office space in Santa Barbara from 2 spaces, actually 3, in downtown Santa Barbara, into one space on Upper State Street in Santa Barbara. So there was a period of time where we were incurring double rent in 2023, and that is actually done with. The other thing is we went through a major system conversion at the bank in October of 2023, just last month. We converted both our core and online banking from our existing vendors to a new vendor. And there was a considerable amount of deconversion costs and employee expense that had to be expensed in 2023 and could not be capitalized. And so we are also on the other side of that as we went through that conversion in October and ran parallel platforms. So we believe for the last 2 months of the year, as well as into 2024, we'll actually have a nice tailwind from an expense standpoint, and should actually see our expense levels come down from the current level. Michelle, am I missing anything there? Did you want to comment any more on that?
No, I think that's true. The change to the system, some people might want to know a little more about that. So contractually, we signed the contract well over a year ago, and it was interesting to see how much the core providers are hungry for banks our size. So we actually are expecting, in like services, if we didn't layer any new services on, a 10% reduction in the cost of our data processing between our core and our digital banking, which was surprising. We expected to gain efficiencies and functionality, but to contractually see a 10% reduction in our data processing costs was a positive. So we look forward to benefiting from that in 24. And on top of it too, we are on a more mainstream core. And so we're excited about new offerings we can offer to our clients, because we were running into situations where our clients here are very tech savvy, regardless of where they are generationally, they want high tech. And we were running into roadblocks of being able to provide that. So we're very excited to be able to expand our offerings in a cost-efficient way for clients. And we also expect to gain efficiencies because we're on one system instead of integrating multiple systems, which takes a lot of back office support to manage. So we are really excited about benefiting from those in 24.
I wanted to throw in one thing just to get it under the wire. One question. There was a significant, merger in your market, CVB buying Community West. Yeah. I think our investors would be interested in how that changes the competitive landscape. I guess there is interest in M&A in your market. If you could just make a couple comments about that, that'd be great. Thanks.
Yeah, actually, that's great. I appreciate that, Ian. And if you guys wouldn't mind kind of going to page 25 and 26 of our presentation while we answer this question. There has been a considerable...
I'm sorry, just real quick, I can't see the page numbers. Can you just tell me what it says at the top?
Sure. Keep going. It's a market disruption, looking back.
Got it. Okay.
I think you're almost there. So there we go. Yeah. So we did this kind of interesting analysis where we go back, 10 years and look at the amount of banks that were headquartered in the market and how many of them have gone away. So if you look over to the left, those highlighted in beige are kind of all banks that have been acquired and are no longer here with the current name. And then if you look over to the right, you can see who's currently headquartered on the Central Coast of California, and you see Montecito Bank and Trust, American Riviera Bank, Community West, and Community Bank of Santa Maria. So I wanted to point out that there is a big merger that got announced between Community West and the Central Valley Community Bank. We believe that there's some interesting opportunities for us that come out of that. You can see now that we'll have one less bank based on the Central Coast of California. And so we will not see Community West headquartered here. It will be actually headquartered in the Central Valley. I think it was a very smart thing for them to maintain the name of Community West, because I think it's a very generic name that will travel in the Central Valley as well as here on the Central Coast. But Community West was actually acquired by Central Valley. And so we do see the loss of one particular competitor headquartered here in the marketplace. The difference for us would be that Community West had often been, very had been very not aggressive necessarily with their deposits, but certainly had wholesale funded their balance sheet to some degree and had needed deposits in general to fund their balance sheet. And so we had a competitor in the marketplace that was certainly offering special rates or offering higher rates than a lot of other competitors in the marketplace. With the merger with Central Valley Community Bank, that has a very strong deposit base and lent deposits to the transaction, when you blend the two together, we should see less wholesale reliance, more of a relationship deposit base. We believe that that will benefit us here in the marketplace, take a little pressure off deposit pricing. I think that we've fared very well with that, with our cost of deposits and cost of funds. But I think it's important to note that we would have one less competitor that would generally be wholesale funding their balance sheet. There, of course, will also be opportunities, you know, for new clients that will come out of disruption in the marketplace. So I think, Ian, I wanted to thank you for addressing that. If you go to the next slide, just so you can see it there, there are very few banks left on the Central Coast. We're probably running out of time.
Well, we really appreciate it. A very detailed walk through your bank and what's going on in your marketplace. We really appreciate that. And thank you.
Thank you.
Great. So I think we'll transition on to the next to keep with the schedule as we.
Yeah, you guys, thank you very much.